You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. So be sure to check out our live stream via the Mixlr app, or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. Learn more about QuickStrike at bantix.com. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. Visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means only one thing. It is time for TWiFO, This Week in Futures Options, program where the name says it all. We break down the week that was and indeed still is on the futures options side of the fence. And you know, if you've been paying attention to any of the headlines, if you haven't been living under a rock, we're probably going to touch on a little thing called Crude this week. My name is Mark Longo from theoptionsinsider.com, as well as, of course, on the ever-exciting The Options Insider Radio Network. Our old buddy Sean still traveling hither and yon. I believe he's on his way back from the big RMC conference that just went down in Germany a few days ago. But I am pleased to be joined in the old CME hot seat this week by an old friend of the network. He is now hanging his hat as the Director of Derivatives Research over there at the TABB Group, Mr. Russell Rhoads. Mr. Rhoads, welcome back to the program, sir.
As always, I am happy to fill in. Sean's shoes are big shoes to fill in for.
You know why I'm excited to have you on, right? Because then it means I get to play this, sir.
Oh, for goodness sakes.
Now, Russell's Weekly Rundown.
Yes, a throwback to the good old days.
The great thing is I get 25 cents every time you play that.
You do. It's rolling in. You got like a whole, I think like
rolling in quarters.
6 1/4 or something in your back pocket right now. Burning a hole.
It's like selling options. It's really kind of just not worth it. Go ahead.
There you go. Don't let our old friend Mr. Schlesinger hear you say that, sir. He'll come.
Not worth the stress.
He'll come knocking on your door. But let's see what's knocking on the old door this week, Mr. Rhoads, in terms of what's moving and shaking. By the way, you guys, as always, can play along with the home game. CMEgroup.com/TWiFO. TWiFO. You head on over there, click on the buttons, kick the tires, and light the fires. And oh my, What a week it has been. You probably can guess what's dominating the top of the upside, with a couple of maybe surprise exceptions. Number 5, up a paltry 3.2% this week, is feeder cattle. One of the surprises there. Number 4, our old friend WTI. Oh, what a week it has been in crude. 6.25% or so to the upside. Then number 3, heating oil. Again in the energy space, 6.27%. We're parsing hundredths now because that's how tight it is. And then RBOB off to the races, up about 8.5%. And then number 1, our old friend lean hogs. A little bit of hog love coming back in the action today, up 8.75% to the downside. We've got silver. Once again, this week, giving back some of the gains. Last week, it sold off again. And then this week, once again, in our top 5 to the downside. Not a place you really want to be, off about 1.6%. Number 4, the old euro dollar, giving back 1.75%. Number 3, oats. Good old oats. Not a huge option story there as well. Maybe one of these days we'll sneak a peek and see what's lighting up in the land of oats. Number 2, our old friend Class 3 milk. You can't talk options on futures without talking Class 3 milk. Everybody knows that. Off 4%. And number 1 with a bullet to the downside, iron ore, off 6.6%. You guys have written in. You've asked us. We talked about it before, iron ore. I wish there was an option story to parse. In fact, we were just talking about this on the option blog not too long ago. Even the folks over there at Fidelity talking iron ore this week. How crazy is that? But there's just not an options real story to go along with the futures move. So we could talk the futures sell-off, but options, volatility, term structure, skew, all that good stuff we like to sink our teeth into, most actives, it's not really there. But when we're talking most actives, Mr. RHOADS, you've been pretty active over there in the land of derivatives at TABB, cranking down and crunching what I believe you refer to these days as your options liquidity matrix. So a lot to parse. You've been crunching the numbers. Let's look back a little bit. You're looking at your numbers here for your, what's been lighting it up in August, lighting it up in over this year so far. We're going to get to crude. I want to let the audience twist a little bit. So what's been lighting up your matrix so far here as you're crunching the numbers for the year?
Well, it's mostly interest rate options have just been going nuts. And I think, and I don't think they get enough love on this show, even though if you look at, gee whiz, the top 5 of the top 10 markets in August for the options on futures markets were interest rate related. Eurodollars, 10-year, the Euro mid curve. I love that. I just love that. That's a little bit longer dated Eurodollar. The 5-year and the 30-year. The 5-year was trading more than the 30-year. 25 years ago when I was like a lot of other people and actually on the floor of the Board of Trade, never in a million years would you have thought that you would have had more 5-year trading than 30-year trading.
It's funny. You mentioned that, they don't get a lot of love on the show, and you're right, they don't. And what's interesting about that, one of the primary reasons for that is my usual cohorts on this program, both Sean and Nick, both former rates guys, both former Eurodollars traders, and both of them, it's like pulling teeth to get them to talk about it now. They
stepped away. They stepped away and they're never coming back.
They refuse. It's like Vietnam. They don't go back there, And so as a result, it's ironic. We have a heavy presence of former rates guys on the show, and yet they just don't want to go there. And so it's kind of funny. So I feel bad dragging them there sometimes. But since you're here, maybe we can get into that in a little bit. If you cutting your teeth there, sir.
I'm happy to talk about anything. You know that.
What else is on your radar? What else is lighting it up? Let's look year to date. And Eurodollars kind of is just. It almost needs its own chart.
Eurodollars is always up there, but the average daily volume through August was, and this is the option, again, this is the options on futures. I don't want to keep saying that over and over again, but it's the options on futures because that's what this show's about. And year to date, the average daily volume in the Eurodollar market is like 1.2 million. Last year, it was 715,000. Just think about that one a little bit.
Get a little Fed action, get a little central bank action. Hey, all of a sudden rates come to life, huh?
Yeah.
Who'd have thunk it?
All it takes. And that's going on, and the volume in the S&P, and this is not just the options on the futures, but the volume in the S&P 500 arena is still under pressure, even though they had a great August. Equity options are off a little bit. Ag options have been doing very well this year. I think we have the Chinese trade war to thank for that, because you never know if they're going to buy stuff or not buy stuff, and when a big buyer of something, you're not sure if they're coming in or not, that creates uncertainty, and that creates option trading and volatility too. Oil option volume was kind of flat in August year over year. Keep in mind the numbers I've got are before, like last week. But year to date, they're actually off about 20%. So I have a funny feeling that number is going to change an awful lot between now and.
What could you possibly be referring to, sir? I don't know what could possibly.
I don't know. We're teasing and twisting people in the wind.
Yeah, a little bit of a tease. We'll hit a couple more, and then we'll get into the madness that is Crude. Again, you can check this out for yourself pretty soon. I think it's going to be released forthwith, sir, on TABB Forum. This matrix, sir.
It may be there. Now, you have to register. I know that it's behind a wall, but it doesn't cost you anything. I get beaten up every time I tweet.
A free wall isn't the same as,
TABB Forum, but all you got to do is, just give us your email address.
Just agree to let Russell contact you at 2 a.m. with his latest matrix via cell phone, and then a text message, and you'll be good to go. Of course, TABB Forum is the place you want to go. Let's break them down really quickly here. The numbers for the top 10 here for the year. Again, this is year-to-date average daily volume. These numbers, if you have issue with them, take it up with Mr. Rhodes. These are his numbers here. Number 10, on the bottom of the 10, the beans, good old soybeans. Year-to-date ADV, 56,600. Number 9, gold, COMEX gold, 63,000. Those sound like a lot. When we get to the top of the top 10, you'll see why maybe not so much. Number 8, good old WTI with 132,000. Number 7, the 30-year. $1.40, and then number 5, corn here. Let me 6, corn. Easy for me to count here today. Number 6, corn, about 147,000. Again, this is year-to-date ADV so far in 2019. Number 5, the 5-year, appropriately enough, about 230,000. Number 4 now, we're getting into some big numbers. The E-mini, 599.8 thousand. That's down from 734,000 this time last year. So interesting stuff there. Number 3, the 10-year, 655. It's actually up nearly 7% from this time last year. The Euro mid-curve, as Mr. Rhodes alluded to, 685 there. That's down from about 720 this time last year. And the old euro dollar, though, that's up, as we mentioned, up strong. It was about 715 ADV for 2018 and 1.2 million as of right now. So again, central banks and the Fed combining, a little bit of trade war maybe in there too. 1, 2, 3 punch, giving euros a lot of love. When you're talking volume, it's kind of hard to put anything else in the same conversation as the euro. It's just such a beast unto itself. We can probably do a whole show called This Week in Euro Dollars. I'm not sure who would tune in outside of the euro dollar pit, but we could do it here really quickly. We've had a couple of complexes, and then we got to keep on rolling. Let's look here. Ag's ADV up 0.6%. So the ag complex from AUG 2018 to 2019. Currencies actually down about almost 24%. So that's why people write in, why isn't there more FX on the show? Hasn't been a lot lighting it up in FX land of late, outside of like some Brexit bubbles and things like that. Metals monthly ADV up nearly 90% August from 2018 to 2019. So that's a big jump there. But speaking of big jumps, we got to get to Mr. Rhodes. We can't tease them anymore. I'm not sure if you heard, but some stuff was happening in Crude. Did you hear this week, sir?
Did something happen in Crude?
I know you're busy, nose to the grindstone, preparing your liquidity matrix.
I was at 100. I was at somebody's 100th birthday party.
Let me ask you this before we get into some of the numbers and things that have been going off. It's been kind of a bit of a recurring theme on some of our other shows this week. In fact, we just got off the option block, and it was a theme there as well. That the market overall, take it however you want. If it's crude, if it's vol, if it's the vol products themselves and the equities, whatever it is, seems to be maybe underpricing the enormity of what happened this week. Are you on that train, or do you think it's pretty much fairly priced?
I actually, I know that the Twitter sphere and everything else is just full of all these people that said, I knew it. But Sunday night, I'm still on a group chat on the text with former and current FIBO instructors. We all kind of bounce things off each other periodically. And we were talking about Sunday night when Crude opened, and the fact that the S&P futures were only down like 10 points or so. We're like, that there is a huge disconnect there. Because if this is a really serious thing, you would expect it to be bleeding over into the business world and equities as well. So yeah. I don't think the overall markets reacted like maybe the bad guys were hoping that it would.
You know, it's funny. I actually started our previous show, the option block. I said if you were under a rock for the last month or so and you just came back from vacation today and you flipped on your screens and you saw S&P over 3,000, you know, WTI high, but not quite as high as it was, and VIX cash at like a 14 hand, actually shy of it for a little while, you'd think all was right with the world, right? You would never know that roughly 5% of production got taken off the board. Yeah,
I mean, WTI it's if you didn't see the spike outside of the range, it's really just at the upper end of a range that it's been in for some time.
So let's put that in some perspective. Of course, it was a historic week, at least from the terms of the damage being done out there. Obviously, the strikes. So was it Iran? Was it not? Seems to be coalescing around it. Probably was Iran at this point, and looks like it took out roughly 5% of global output. That's how much oil goes through this one facility, the Saudi Aramco facility there. To put it in perspective, and the folks, I think it was StockTwits, put this chart together. If it's not, I apologize for who crunched the numbers here. But this was effectively, if you look at the numbers of how many barrels per day were taken offline, this was the biggest oil disruption in history in terms of pure amount of barrels per day. In general, looking at barrels per day, these Saudi strikes took off what is approximated to be about 5.7 million barrels per day. That puts it actually a tenth above the Iranian Revolution, 1978. They lost 5.6 million barrels a day. The Iraq invasion of Kuwait only took off 4.3 million barrels per day by comparison. Same thing with the Arab-Israeli war and the Arab oil embargo back in 73 to 74. The Iran-Iraq war only took off 4.1 million barrels. Then we drop off quite a bit. Venezuelan strike in 2002, 2.6. The actual war in Iraq in 2003, only 2.3 million barrels. That puts us all in perspective. We're talking over 2x that just for this one strike. The old Six-Day War back in 1967, obviously the crude markets back then, a little bit of a different beast, but still interesting all the way down to the bottom of Hurricane Gustav and Ike in 2008, took off 1.3 million barrels. That's obviously some of the domestic production, but still interesting. So that puts it in perspective, 5.7 million barrels a day, just taken off the board like that. And you would think that would cause all sorts of just catastrophic reverberations throughout the crude market. And you did at first, as Russell kind of alluded to. We saw a gap up when it opened up this weekend coming into the early part of the week. And the initial gap up, I mean, we saw crude going out. The WTI was at about, looks like I think it was about a little bit shy of 55, like 54 or 79 before all this started unfolding. Afterwards, when it reopened again, it gapped up initially to about a little over 60. So that puts it up right around 10% or so. So again, not a catastrophic move upward. We saw it hit its high, at least that front contract that's going out tomorrow out there at CME hit its high of about 63.12 or so. That was on the 16th. That puts up the gap up to the upside at about a little over 15%. Then Tuesday, later in the week, once the Saudis started coming out and saying, we're going to get all this back in line by the end of the month, that's a fairly aggressive outlook. I mean, if you ever saw any of that footage coming out of the Gulf War the first time, how hard it was to put out all those oil fires. That's an impressive amount of work, but the Saudis say they can do it. The market clearly believed in them because we saw that pretty much turn around, got down to about 58 and a quarter or so on Tuesday. Wednesday back down to about 57 and a half. Coming into today, of course, with all this news of the Iranian strikes and, the Secretary of State saying it was an act of war and everything like that, we saw WTI spiking up a little bit, that front contract getting up to about 59 and change, 59 and a half today. As of right now, it's settled off a little bit again. That kind of goes back. Russell, there's been another narrative here, and this seems to reinforce it very starkly. We've been talking to some market makers and others in the WTI space on the show lately, and they've all been saying that, and other guests as well, that, every pop there is in crude, it's just a chance for the market to just fade the hell out of it, sell all of the upside calls they possibly can, because the overarching narrative is still languishing global macroeconomic demand is just falling off a cliff, and that's really the narrative. And so any pop that happens, they're just taking it as an opportunity to sell. It would seem like, given how the price action is right here, this seems to reinforce that. What do you think?
Yeah, I think it reinforces it. I think the dynamic change here is that, and I feel like I said this on this program a month or two ago, that in the oil market, when I was growing up and I started getting involved in the trading business, there always seemed to be what we would consider a geopolitical risk premium to the price of oil. And it seems like it had gone, ever since the Iraq war, I guess, it really just seems like it had gone away, that there was always like a little extra premium in there, that what happens if something ignites in the Middle East. And I do think it's possible that what just happened may reintroduce that premium to the market. So, we were, 56 or so when this happened, and now we're in the 58, 59 range. So we could easily say that maybe $2 is going to be a risk premium just for a little while, because people maybe aren't as comfortable being short over a weekend in the oil market as they were like this time last week.
You would hope if this event doesn't do it right, what's going to bring it back, right?
At the same time, you'll have that extra risk premium, but the economy everywhere looks like it's slowing, and when that happens, this market is like a teeter-totter with respect to supply and demand. It takes very little slack of demand and to push prices lower, and we probably would continue our trend lower. Just maybe in how we change volatility regimes. Maybe we're changing to a different regime with respect to the low end and the high end, because we'll put a little bit of an extra risk premium in there.
Yeah, it's been funny because we've been waiting for that. There's been escalating tensions, obviously, in the Middle East for some time, escalating events, seizing a tanker here, this event there, and ratcheting it up slowly but surely. And the market seems to shrug all of them off in favor of the broad macro picture. Instead, this is obviously about as extreme as we have seen so far in the Middle East. And if you pulled up the TWiFO report right now, as you mentioned, Russell, you probably would think something happened in crude this week, but you probably wouldn't think it was something this order of magnitude. Like I said, we're up about a little over 6.33% right now, about 3.5 handles, right about threatening that 58, actually 58.25 or so. Vol up and up pretty firmly in the near portion of the curve. Get out of those gamma contracts the first couple of weeks. We still are talking, 6 to 7 points in things that are even a few weeks to a month out. So up firm, so you would know something was afoot, but not quite perhaps the just explosive activity you would think. And you're asking, let's talk about that activity. Let's see, what was lighting it up this week? What was number one with a bullet in this unprecedented week here, at least from a amount of crude taken offline perspective here this week? If you said it was upside, you were correct. Pretty aggressive upside too. Again, remember, it looked like for a while there, people thought maybe, or maybe they thought they were fading it. Either way, we got to hit that 63 and change or so. We started to threaten the mid-60 handle. And so maybe people thought we could hit that 70 level. And so either way, 70 calls out there in Nove were where the action was this week. Doing, as we see right now, about almost 21,000. Decent paper, not even that much paper out there this week, which is also kind of surprising. OI up pretty strong, about 7%. So that's a good sign in terms of a lot of volume back coming into the marketplace this week. But net, the biggest trade out here actually isn't one of the bigger ones we've seen. It's about 21,000 of the 70 calls. Those going up pretty active throughout the week. The big day actually was Monday. No surprise there, coming off of the heels of that big spike into the open there. 8,000 contracts on Monday, about 5,000 on Tuesday. Settles out a bit, obviously. 70 not really in the radar after the Saudis start talking it down there on Wednesday. And then today, maybe some of the threats back and forth, putting 70 back in the crosshairs. Either way, about nearly 5,000 so far have gone up today. And obviously this is opening paper net bias, about 4,000 contracts. So opening upside paper. Let's look at the skew here in Nove and see what is afoot. These have roughly, let's see, roughly about 2 months to go, at 59 days or so. So there's a decent amount of time here. 42% of the paper this week coming in the Nove part of the cycle here. Let's see what's looking from a skew perspective. Let's see if this changed things. Remember, one of the narratives you've had here for a while too is that the call wing can't really catch a bid. Let's see if that happened this week. We got the puts here. The puts were 5.9% cheap to the at the money this week. And again, as you see a vol explosion, you're going to see some of this. The vol did explode. Maybe not as much as you would think, but it still is exploding. So you're going to see some changes to the skew just as a result of that. Up now, the puts are 9.5% rich to the at the money. Again, it's not surprising too if you see shoot up and then pretty much immediate retracement. Puts are going to catch some life, and that's pretty much what we saw. So going from nearly 6% cheap to the at the money, below the at the money, to nearly 10% above the at the money, just in the span of a week. So that's a pretty sizable move on the put wing there. On the calls were nearly 12% rich to the at the money last week. So a surprising bit of bid to those calls. And this week they have cratered. Again, that kind of goes back to what we were saying. Probably sounds like maybe a lot of this 70s paper was opening sales. We'll see. They have cratered. They're now down 6.7% cheap, so below the at the money. So a little swing there in the skew as we shoot right up and shoot right back down again. The calls had a bid, and that bid is now has now been crushed. Is that pretty much what you're seeing out there as well, Mr. Rhodes? I know WTI skew has kind of been a point of fascination for you of lately. What's been on your radar from that perspective this week?
It did not, go up and hold and then tilt back down. It's like everything else in reaction to this thing. It was like a day and a half at the most reaction, and now everything's just going back to normal. I'm sure, when you started thinking in your mind what we were going to talk about today on Monday, you probably were thinking we're going to be doing nothing but rattling off all these incredible statistics about oil, and they ain't there. Which actually is kind of, which is kind of the story in itself.
Yeah, I was kind of wishing TWiFO was on Monday. There was so much going on. It seemed like it was going to be the apocalypse by the time we got to Thursday.
I mean, how did we get to the point of where, a 20th, 1 out of 20 barrels that comes out is suddenly offline, and you've got two of the biggest producers in the world in one of the most volatile regions in the world pointing guns at each other? How did we get to this point where we're just reverting back to where prices were? Looks to me, looking on the October contract, we're right back where we were like 6 days ago.
It is fascinating. Clearly, the market is buying what the Saudis are selling in terms of being able to restore this production. I mean, this would be an unprecedented level of restoration. I don't think anyone's restored this much capacity that quickly in the past. But I guess if anyone's poised to do it, I guess the Saudis are the one. I guess we'll see very quickly.
Well, they can tell us they're going to do it. They can say, hey, we're doing it. And I don't know how easy it is for us to check.
Yeah, they have those reserves they can kind of dip into a little bit, too. So that kind of muddies the waters.
Yeah.
I'm going to ask you about your liquidity matrix. Obviously, these numbers are pre this weekend, so that's not in there. But were there any nuggets that really stood out to you as you were crunching your volatility monitor?
I actually have the numbers going through a couple of days ago. And so I had already started updating it. And even with the spike that we had in oil volatility this week, calculating the average 30-day at-the-money volatility for the oil options, it was 32.35 or 32.35% on average in August. It's only up around 34.6 for this month. Even with what just happened, it only got as high as 45.
Yeah, I mean, the narrative coming out of this is just kind of a collective shrug, it seems like, across the board. It's kind of hard to really wrap your heads around this. If you had seen something, what the analogous, some massive names in the equity space announcing their earnings had been annihilated, as a result, you would see, huge reactions out there, and yet you're just not seeing it.
This is a Seinfeld event. It is. I mean, that's what I would, when people would ask me about news items that didn't move a stock and weren't anticipated by the options very much, I'd just say it's a Seinfeld thing. It's about nothing. Nobody cares. Or people care. We're talking about it, but still, it was about nothing.
Whoever would think we would say that?
And it's just odd. In a million years, I never would have thought by this time this week, I would have thought that it would have come in some. Because it usually takes about a day and a half, 2 days for these things to reverse. But I didn't think it would come in this much.
Yeah, I was thinking, we're going to have so much to parse on Thursday on TWiFO. It's going to be just madness. It's going to be, we have to have a double-length show. We're going to have all sorts of experts in to parse what's going on. And the truth is, you're right. We saw a little bit of a blip, and then it's come in. Even the volume this week, I mean, it's decent, but it's not blowing the doors off. It's a very strange thing. We could keep parsing it, but let's talk with some other places where I know this is also your neck of the woods. I don't know if you know this, Mr. Rhodes, but you used to like to talk about equity volatility. Did you know that?
I used to. I used to spend a lot of time paying attention to it. I still do.
That used to be your
I've re-upped the work on the VIX book.
Every author I know who says that always say it so glumly. I'm writing a book again.
I've re-upped the boycott. Well, it's just because my publisher's flying over from London to check in on me next week. And so, yeah, I need to do something.
Well, when the big dog's in town, I guess you gotta make it look like you're doing something. Vol is doing a little bit of something this week from a broad equity perspective, but maybe not, again, kind of keeping with that narrative of the Saudis and crude, maybe not doing as much as you would think. Getting a little bit of a lift today. It's kind of a weird day. We saw markets again rallying today, and most of the indices were looking actually pretty good throughout the week. Of course, we had the Fed earlier this week kind of given the equity markets a little bit of lift, pretty much in line with what we were thinking. I think the futures went out somewhere around 80-odd% in terms of the Fed watch, in terms of expecting that quarter point cut, which is pretty much exactly what we got out there. In terms of where we're living out there right now, by the way, listeners, if you're playing along with the home game, head on over to the equities section. Let's start in Russell 2000 land. Our buddy Sean couldn't be here, so let's see what he's been up to in our absence. And Russell, off a bit on the week, actually. Russell, you said for a while, has kind of been dancing to the beat of its own drummer. Not just the Russell we have on our show here today. He also does that. But the Russell 2000 in particular, off almost 1% here this week, about 1565 or so, right around the at-the-money strike. And we've seen for a while the narrative out here has been kind of out-of-the-money puts is kind of where all the action is in the Russell 2000 options over there at CME. And that continues to be the case this week. The big block is about 1,500 of the, ironically enough, 1,500 puts going up out here in the week 3 in Nove. That's where pretty much the lion's share of the action is this week. Let's go on out to the S&P 500, the E-mini SP 500, see if that's a similar case. By the way, let's do a little vol breakdown while we're at it. It's a VIX cash hovering right around a 14. That puts us actually up. It was a 1330 or so earlier in the session. So we have seen a little bit of vol ticking up as maybe the market's starting to digest what's going on over there in the Middle East, and indeed coming out of these European central banks as well. So about 14. That puts us down a little less than a point from last show. The volatility, aka our old friend VVIX, at about a 97 or so, puts us down about almost 4 handles from last show. And of course, our old friend RVX, weirdly, aka the VIX of the Russell 2000, is weirdly unched from this time last week, almost exactly. It was about 1870 last week. It is 1875 now. You know what that means, listeners. VIX moving all over the place, and that puts that spread even wider than it was. It was over a 5 handle for a while there today as VIX keeps moving around and RVX seems kind of locked at that 1870 or so level. Now it's come in a little bit as VIX cash has gotten a little bit of love. It's still at about a 470. Mr. Rhodes, at this level of that kind of VIX to RVX spread, does this start to make the hairs on the back of your neck start to stand up a little bit, sir? Maybe there's some opportunity there?
Gosh. I could go either way on that one. You know, it's not... I like to look at it as a ratio more than looking at it as, just one minus the other one. So, what is this, about a 30% premium or so? I wouldn't, not quite yet.
Not quite yet, huh?
Not quite, and we can't trade it anymore, but when we had I think we can't trade it anymore, but because I remember they were delisting the RVX futures contracts. But the spread's okay, it's not great. You could think about buying VIX and shorting RVX when you have the futures to do that. I'd want another point or two before I thought about doing that.
It is a little more difficult, and I got to leg through the options on the underlyings themselves now to really to make it happen.
Yeah, now it's just it's a difficulty. We'll put it that way. The only reason that I would actually give some thought to buying VIX and shorting RVX or buying S&P volatility and selling Russell volatility is I think a lot of people will be shocked if we make it through the end of this year without some sort of big sell-off in the equity markets or some sort of big geopolitical event. And when that happens, you will see it hit S&P 500 volatility much harder to the upside than Russell 2000 volatility. So if you can come up with a really cool way to maybe take a lot of the pricing risk out of there and get long vol in the S&P 500 and short vol in the Russell 2000, I can give you a fundamental argument for it right now, and I can't argue against the pricing here, but I think you might get a better opportunity to put it on at some point.
Well, I know one of the highlights of your liquidity matrix this time, you kind of touched on it at the top of the show, are the E-mini S&P 500 options doing some paper in August. Go figure. Any nuggets standing out to you in the E-mini this past month or indeed this year, sir?
The volume in the S&P, is just very reactive volume-wise and volatility-wise to moves in the underlying market. And even though we had some okay volatility events earlier in this year, you didn't see the panic type of buying that you've seen in the past in S&P 500 options. It's kind of like, I don't know if everybody was like, nah, nothing bad's going to happen until the second half of this year. I feel like, and then I also saw some decent volume trends periodically when vol was low, looking out at the September, October options, like maybe people were getting smart and buying their insurance when it was on sale. But these moves that we had in August, it looks like not everybody bought, and there was actually for the first time this year, maybe some panic type buying of protection in the S&P options. And they're basically interchangeable without getting into the weeds too much as far as the options on the S&P futures, the index options, and the options on the ETFs. If you're thinking about buying something and then turning around and selling it at some point, they're pretty much going to give you the same sort of protection. And I think all of them benefited from the volatility in August, and maybe the volatility in August combined with people being more concerned, or maybe just people taking a look at the time of year that's coming up on us.
Mr. Rhoads, you are our guest. We have people writing in all the time. In fact, I got reached out to by some listeners last week asking for more ags on the show. So we could go ags next, but you're our guest. I'll let you pick where we want to go. Where do you want to hang our hat next, sir?
Go ags next, because ags have been kind of interesting, and they've been a little bit of an outlier as far as volatility moves go.
Let's get to that. What have you found in your volatility matrix for the ag so far, sir?
Well, it's the one area, because we did add a volatility component to the options liquidity matrix this summer. And so I look at, basically I've always looked at volatility, and this goes back to the VIX, when I was spending most of my time monitoring VIX. I take a look at over time periods what the high, low, and average is, because I just don't think day-to-day changes in volatility tell you a good story. And the average for the two most active option markets or optional futures markets are, as we mentioned earlier, the corn and the soybeans. And when you take a look at the markets that the markets August average 30-day volatility in August versus average 30-day volatility in July, and you look at the 10 most actively traded markets at CME Group, the only two that saw a drop in volatility expectations in August were the agricultural markets. And you've got to assume that's just because they had been in the news so much all summer with respect to the continuing, I don't know if it's brewing, continuing, agitated trade war, I don't know what it is, but based on those markets reacting and then people being concerned about future reactions to whether or not China's going to be buying a whole bunch of the stuff we grow here in the Midwest.
Yeah, if you talk to the soybean folks, they are a grim lot right now. They're saying this is volume and growth and demand that's never going to come back here to the U.S. It has moved to Brazil. Brazil has increased their infrastructure and their growing capacity to be able to deliver that, and also Chinese demand slowing as all of their hogs are dying from swine flu. So kind of a bit of a 1-2 punch. Chinese demand slackening and also moving offshore, and that's the hard thing to get back. The numbers coming out this week from the September crop report showing leaning on the higher side, actually, what the estimates were going into it, showing corn and soybean yields down from 2018. That's probably not a surprise there, but actually lower than the projections posted for the August crop report as well. Corn production, we have got some corn heads there in the audience. The corn production now estimated at 13.8 billion bushels. That's 1% lower than what it was coming in August. Soybeans projected at 3.6 billion bushels. That's down slightly as well from the August estimate, but down, you look year over year, just down 20% from last year. Corn, by way of comparison, down a mere 4%. By comparison. Let's hit on that corn really quickly because it was a fairly active week out there for corn. Looking here, it's at about a 373 right now. It's up a little over 1%, about 1.15% or so. Not a lot going on from a vol perspective out here, but in terms of action, it actually was, again, effectively these dailies. There are dailies now, these ACK weeklies that or the ACK contract was going out pretty much in a day. Going up to 365 puts, that's where pretty much the lion's share of the biggest trade of the week was. The actual lion's share of the paper was in D's with 36%, about 29% coming in this ACK contract here. And the ACK puts, 365 puts, so these are slightly out of the money puts here now, doing about 18,000 contract. The big day was Tuesday, 7,200. Also pretty active today, about 5,500 today, about 5,000 yesterday. So the latter portion of the week kicking into high gear for these 365 puts. It's interesting so much paper can go up. Let's look at the opening versus closings. These are going away pretty quickly. Actually slightly opening, which is kind of interesting for a contract that's going out in about a day. That's always endless fascination to me on the commodity side. People are willing and continue to open positions with a day or so to go, which on the equity side, you don't really see that too often. It's just premium harvesting. All that if they're opening, it's opening to harvest. And that's about it. Let's also 3.5 puts were pretty active this week as well. These were out in D's, doing about 12,500 contracts as well here. Let's look really quickly. I'm not going to do the 1 day to go skew. So let's go out to D's. And let's look at the skew out here. Puts coming in a little bit. They were 3.3% cheap at the money. Now they're 4.1% cheap at the money, so getting cheaper. And the calls were 5.2% rich. This week they're 5.6%. Get a little bit more bid to the calls, a little bit more life to the upside, a little bit of weakness to the downside. Kind of what you would expect here on the corn side. Mr. Rhodes, we could do beans, but let's...
I want to talk about corn for a second.
Go for it.
All right. I mentioned I'm looking at the 30-day volatility expectations. I'm only using at-the-money options, so I'm not infringing on the VIX calculation. But June, July, August, September. And September's the average through yesterday. Here's the corn at-the-money 30-day corn volatility: 35, 29, 25, and 21 since June. It has been nothing but a straight down line.
Yeah, that is interesting.
It's a volatility crush or a slow volatility
implosion. You think there'd be a market for a corn VIX?
Yep.
Think the ag guys would like to see something like that?
There was one. There was a corn VIX and a bean VIX. I have all these old tickers tattooed on my forearm, and only one. And then I get a tattoo where I cross them out, where they stop quoting them anymore. Well,
I know obviously OIV is crude. What was the one for corn?
I think it might have been CIV. I think that would kind of make sense, wouldn't it? The CBOT Corn Volatility Index, CIV.
Look at you with the obscure tickers.
And I just found a quote on Yahoo Finance from June 12th. So I do think they stopped quoting that.
I was going to say, are they still disseminating that? Ballyhoo to them if they are. I want to go pick that up. But yeah, that would be. It is fascinating where the vol ball lands and where people pick it up. Mm-hmm. Remember the old GVZ days? Who would have thought gold vol? That would have been a no-brainer, right?
I loved that one. I traded it a few times.
Oh, you were the guy.
So, one of the nice things about working in the Institute, I got to trade those things.
You were the guy. When the 3 lots would go up, that was you.
I was 100% of the open interest in GVZ at one point.
Yes. I don't find that surprising. Since we're talking gold, should we head into the metals?
Sure.
All right, listeners, if you're playing along with the home game, head on over to that drop down, go down to where it says metals, click on the precious stuff, unless you want to go base or ferrous. I won't hold it against you. We're not going to talk about those here, but hey, to each their own, whatever floats your boat. Coming into the showtime here, we're seeing gold right around threatening. It's up about 0.5% on the week, and it's just shy of that magical, mythical 1,500 level. Of course, we were north of it earlier this week. We had the Fed and some other developments conspiring to draw us down south of it again. Maybe folks, certainly at the beginning of the week, they were liking themselves some flight to quality. Later portion of the week, guess you don't need it. All is right with the world again. So yeah, an interesting week out here in the precious stuff. Vol, a bit of a mixed bag when you get into that kind of gamma territory, which is 2 weeks or less. It's pretty much all coming off. If you get a little bit beyond that, it's up, but up slightly. Again, we talked about gold vol before. It's not exactly the biggest mover and shaker out there. Mr. Rhodes, in your various matrices of volatility and liquidity, anything really surprising you out there in gold and precious metals these days?
Nothing really surprising. I mean, gold's been in the news for a little while. You know, they still have GVZ as an index, and with GVZ basically was at all-time lows about this time last year. So you would expect that with the sudden breakout and the sudden renewed interest that gold prices are getting, that GVZ would be back up at, and the same thing with gold, with the volatility of the options on gold futures. You would expect that you would have seen a big old spike like up to the 20s, which is where it used to spend a lot of its time, and it's still like in the mid-teens. So the lack of just the lack of volatility expectations in gold, again, when they're trying to start World War III over there when we're sleeping or out having fun on the weekends, it just makes you scratch your head an awful lot. But when we always look back at these things, the markets end up being right. So maybe the market's not panicking, the market's got it right.
Does put the notion of weekend risk into perspective, does it not, sir?
It does. It does. It's not something I think a lot of us have thought about too much since everybody started ignoring whenever China would put their economic numbers out on Saturdays. So that used to be the last weekend risk, and then before that, I think we go back to 2008. But yeah, if you're involved in the energy markets, I'll bet you're going to be a little bit more skittish about putting on or having a short position you can't get out of until Sunday night on a Friday afternoon.
I would have to think if this doesn't teach you and slap your hand a little bit on that, then what's it going to take, right?
Yeah. And that's where that risk premium, I think, will start to come into play.
Mr. Rhoads, you're our guest. I shall leave the final determination up to you. You want to squeeze in one more product, or you want to go to the listeners?
What's left of my choices, and let's go to the listeners.
All right, let's go to the listeners then with a little bit of your... He's punting to you guys. Let's see if you can pick up the slack as we head on into your futures options feedback.
It's time for your questions, comments, and it's time for futures options feedback. Submit your questions at twitter.com facebook.com/options insider, twitch.com/options insider, or via questions@optionsinsider.com. You can also submit via our Options Radio Network mobile app, available for iOS and Android Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixler chat room. So grab the Mixler app or just search Insider at Mixler.com. That's MIXLR.com.
All right, time for you guys to take the reins. See if you can outshine Mr. Rhoads here in the hot seat. First up, we got, that's an interesting handle, RETRIBRAND. RETRIBRAND wants to know, a bit of a subjective one. What is the most interesting CME product from a skew perspective? Interesting is obviously a subjective term, and there are many products out there. I think I could probably, off the top of my head, say what complex is not the most interesting from a skew, but that's probably the equity complex. We don't see a lot of really extreme vacillation. When I think interesting, that's what I'm looking for. I'm looking for extreme moves, a lot of evolution, a lot you could really do with the skew. It's changing maybe week to week. It's bid to the calls. It's bid to the puts. It's giving a little bit of life, a little bit something fun to watch. You're not seeing that in the equities. You're seeing a change of slope. The puts maybe a little bit more bid this week, a little bit less bid next week, but this never, outside of some aberrant events, you're not going to see a lot of dramatic swings, really, in this skew. So maybe on the latter portion, I would say equities, not one of the more interesting. So maybe, I guess if I had, using that logic, I probably would have to lean out to some of the commodity space. Maybe the metals. I like the metals. You could obviously, big skew moves, you could have some really illiquid thing, and I don't want that either. So maybe if something has a decent amount of liquidity and also, so you can trade it, but also has some decent movement to the skews, I'm probably going to go somewhere in the metals, maybe some of the ags. The ags have had some interesting swings and skews, not so much of late, but they have been known in the past. One of our other questions is about the beans. We'll get to that in a little bit, but so I would probably maybe somewhere in the precious metals. Mr. Rhoads, where do you hang your hat on this one?
Energy. I've always liked the oil skew. You know that. You brought that up earlier.
But it's so weak. It's so weak lately. You can't get behind it.
I know. Well, I'm going to say one that I've never looked at, but I'll bet you is fun.
Nat gas might be a candidate there.
Natural gas. Yeah, that if I had to guess without, if we were on the L chatting on our way to some sort of event and we didn't have any machines in front of us, I would guess nat gas. And part of that's because I like I said, I've been looking at the average volatility, and it was in the hundreds 1 month this year. So you got to assume everything else was jerking around as well. If it even behaves half as much as crude oil does with respect to the skew going up and down, but at the much higher levels, probably a lot more.
Nat gas was always that one that was kind of locked to the upside for so long. It had that limit; it couldn't go through. Right, then it blew through it, and it changed everyone's expectations. So I would say pre that, it was probably pretty boring. These days, now you're right; it's kind of an interesting one. I just pulled it up here while we're talking really quickly. The active contract has about 6 days to go. Let's go out a little bit. Let's go out to Dees. Why not? It's fun. And let's see the puts. They have come in a bit. They're about 5.6%. cheap to the at the money. They were 2% cheap last week, and the calls were about 5.5% rich to the at the money. Now they're about almost 10%, 9.1%. So calls getting a little bit of lift. So yeah, nat gas, not a bad one either. I mean, we do see nice little swings in gold skew as well, so I put gold out there. I think you can't go wrong with either of those. And also, they do some paper. It's not like lean hogs where, it kind of trains by appointment. You can actually get some paper too. We got more skew questions. Let's see if we got another one here. Eli wants to know. So I'm checking out the OIR catalog, the OIR back catalog, and came across the early episodes of TWiFO. Well, hope you're having fun there on your time machine voyage there, Eli. He goes on to write, he says, how the commodity landscape has changed. In those early episodes, you were talking about soybeans as great candidates for collar trades. Do you foresee us getting back to that situation anytime soon? And any other products where collars might be favored? I remember those early days of TWiFO quite well there, Eli. And you're right, that was kind of one of the early stories we were able to really sink our teeth into here on the show. Obviously, this was all pre-trade war, and it was a great environment for collars out in soybeans. Remember, of course, collar listeners are going to be long the futures and then buy a put, sell a call, hopefully to finance that. And what you want, obviously, an ideal structure for that is a put skew that is very cheap, so you can buy a put and get that protection nice and close to the at the money for not a lot of dollars. And then you want a tremendous bid to the call wing so you can turn around and sell that call and probably hopefully pay for some, if not all of that put. And I think back in those soybean days when the calls are so big, you could get more. You can get a credit on that. So that's kind of the ideal setup. You got to put on a long future with very little downside, and you get some nice upside, and you get a nice little, maybe even collect a credit to do it on that side. That was ideal. That was rare. You don't see that very often. That was for the variety of nuances of what was going on in the beans market at that time. So that's what you need to have a favorable collar setup, is a skew situation similar to that. Obviously, you want to have a little bit of upside viewpoint on the futures levels too. That's obviously a key consideration. But then again, with you can buy the protection so cheaply and get it nice and tight, that's not as much of a concern. Perhaps it's almost like a cheap roll of the dice there at that point. Mr. Rhodes, do you recall those heady days of soybeans a few years ago when collars were just willy-nilly and we were all fast and young and carefree? And then do you foresee any other products right now where collars are lining up nicely?
With the soybeans, I do recall that, but I think the fundamentals have shifted around to a point where it's not as easy to do. None of the markets are popping out at me. I've been scrolling through some of the volatility skews trying to see if something makes sense in that, in that same old vein back from when I wasn't even allowed on the show.
The good old days when you were banned.
None of them are popping out at me, and I'm struggling and trying. Yeah, the good old days when I was banned.
Yeah, nothing. You're right. Nothing's leaping out to me. I mean, you're.
Yeah, I'm trying. I try. I'll build charts and tweet them while we're talking and everything else, but I can't. I just can't. I'm trying, but I can't.
We need some. I think they have them in there. I'll have to pull them out for some little, some good skew cross-platform, cross-product scans so we can kind of compare and contrast at a glance. See, the problem with that is, Mr. Eli, I think, is you could go out there and see. Something that has a similar shape to the skew. The calls are bid, the puts are kind of offered, and hey, that's favorable. But then you go out there and it trades like 3 contracts a week. So I would never say that's favorable either. So you need that liquidity component. That's kind of the third. So that's why I keep coming back to some of the more liquid ones. Usually you see a nice bid not a ton these days, but some to the upside in some of the precious metals. So that might be an area you could look. And again, the ags kind of have a different thing going on now, obviously, than they did when TWiFO first came online, so not quite as favorable there. But those are in the commodity space where there tends to be sometimes be concern to the upside. That's where you get a nice, healthy bid to that call wing. And so that's where you kind of have to look, maybe in the metals, some of the ags. Again, try to keep it to the larger ones. And nat gas, they had that crazy explosion to the upside, so they were crazy bid for a while there. It's come off a bit now, obviously. Still almost 10% rich to the at-the-money there on the call side, so maybe nat gas might be a place that's lining up there. And that's maybe a good bit of homework for next week. Where is the new soybeans for 2019? Where is the place where you can put on nice tight collars, get decent levels to do it, and everyone is a happy camper? Unfortunately, listeners, that music, man, it's already been an hour. Mr. Rhodes, time flies when I'm chatting with you, sir.
Yep.
Hopefully that hot seat wasn't too hot this week, sir. Were you okay?
It was quite fun.
Well, now before we go, sir, if folks are liking what you're talking about here, they want to check it out for themselves, maybe you want to give them a little bit of a hint of what's coming up. What's up your sleeve over there in TABB land, sir?
They basically I think I've got the option liquidity matrix where I want it. We are actually going to start putting out, and this is in the equity space, but with this new earnings season, I've rebuilt my database. I'm going to start sharing what companies have done historically based earnings-wise and compare the straddles to them. And we're going to do several historical studies around different strategies that may consistently and not consistently work around earnings. That's the big option stuff.
Earnings, always a sexy time, and it kind of never ends, right? One cycle winds down, the next one just kicks right off again. So it's if you want to hang your hat on earnings, there's a lot to parse over there. Yep, check them out over there. TABB Forum is the place to go to find. Hey, did I see you guys have a big crypto thing recently? Was that correct?
We did. We had our crypto conference last week.
How did that go?
It went extremely well. It was we're up about 25% attendee-wise. I moderated a panel where we talked about the challenges of what data is real and what's not, and also talked about some ways to approach that market in from a fundamental standpoint.
Any surprising, interesting takeaways from that crypto conference, sir?
It was interesting that just about everybody has somebody that manually goes through their data and makes sure they're getting the right data. Nobody trusts any data they're getting.
Well, it is kind of a fractured data set out there in the crypto space, right?
Yeah, but I mean, it was a bigger. People were spending a lot more time on it, and then when they get their data figured out and they consider it clean, they don't share it.
That's a competitive advantage, right? So there you go.
So there.
We just had the folks from Gemini on our crypto show this week, who are actually now one of the newest additions to the CME Bitcoin reference rate over there. So more venues getting added to that. And they were talking about doing that as well, kind of cleaning up the plumbing in the crypto space, make transactions, make custody get dealt with a lot faster. All these issues that are not the sexiest of the world, but they keep a market from getting to that next level. So a lot of people, sounds like at your event as well, we're focusing on that crypto plumbing. It's getting there. Hopefully, as a result, maybe we'll see some options over there from the folks at CME as well. Of course, head on over to CMEgroup.com/TWiFO in between shows. So you can check out the reports. And it's all live throughout the week, listen, not just showtime. You have to maybe play with the dates a little bit if you want to line it up with the show. That's where you can go kick the tires and light the fires. Of course, our buddy Sean still traveling out there, hither and yon. Check him out, I should say. FTSERussell.com is the place to go. Give him a follow over there on Twitter as well, at FTSERussell. A lot of great data coming out there throughout the week. And on behalf of Sean, and let's give Mr. Rhodes, let's throw him in there as well. Someday in the future, Dr. VVIX, and indeed myself. I want to thank all of you out there for downloading, streaming, subscribing, for sending in so many different questions about skew. You all love skew. It's okay. We love it too. And we'll see you back here tomorrow for Volatility Views. Then we do it all back again on Monday for Option Block, and right back here again on Thursday for This Week in Futures Options.
This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. build trades, manage risk, or explore historical volatility, QuickStrike has you covered. With market data reports ranging from open interest to the term structure of volatility, QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available on the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.